Mark Denham, you're head of European equities at Carmignac Gestion. The European stock markets have lost significant value, around 10% last year. What's your forecast for 2019?
Well, first of all, you're absolutely right. European markets were weak in 2018, falling about between 9 and 10%, and especially weak in Q4. And of course, European companies are not immune from the global slowdown. We're seeing a slowdown in China and elsewhere, and of course economic indicators within Europe themselves are slowing down. So to a large degree the stock market was anticipating that and anticipating downgrades to earnings forecasts, which still in Europe the consensus forecast is for 7 to 8% profits growth in 2019. We think that's unlikely. It's more likely to be 3 to 4%, and of course the stock market anticipates that and was weak towards the end of the year.
Do you talk about the end of the year? Investors didn't like the fourth quarter, of course. Now, how did Carmignac react to that turmoil by the end of the year?
Within our portfolios, we were very conscious that the Q4 reporting season was likely to be a very uncertain and volatile one, and so we reduced our positions in sectors that we thought would be most vulnerable, such as, for instance, in semiconductors, where we own ASML, the equipment company, as well as some of the mid-cap biotech stocks, which tend to be quite high beta stocks, and so we reduced those in Q4 as well.
Now, is it a time to go back to those stocks, or actually as a stock picker in general, what sectors do you prefer over others? Which are the sectors you probably leave out at this moment?
Well, I think with the European market having fallen already, especially in Q4, and with the valuation of the market with a P rating of 13 times below its long-term middle of the range, and with a dividend yield of 4.2%, again very appealing, I think we're getting close to a very attractive entry point for European equities. I think we still have to get through this Q4 reporting season, which has just started, and as this downgrading process takes place, but I think over the coming weeks we will be adding more risk to our positions and looking forward to a positive return from here. Now, within the market, our emphasis is always on stocks that to some extent can grow under their own steam, even in a relatively subdued European economic environment. So we look for businesses that have high sustainable profitability combined with reinvestment for the future, which enables a kind of compounding effect in the value of the company. And that leads us to sectors where there's high value added, sectors in the healthcare sector, whether it's big pharma, medtech or biotech, also in technology, and also in other sectors, businesses, a range of businesses such as Assa Abloy, the Swedish lock company, or London Stock Exchange in the UK, which also have these double characteristics of high profitability combined with reinvestment.
Now, Carmignac doesn't own Swiss Blue Chips, but still, there you're confronted, of course, inevitably with banking, pharmaceuticals, and food and drink. So what's your opinion on those? I mean, starting with the banking industry.
Sure. I mean, first of all, we have nothing against Switzerland. It's just that we are pure bottom-up stock pickers, and it happens to be the case that we don't own the Swiss large-cap stocks at the moment. I mean, the banking sector, though, is a sector that exhibits exactly the opposite characteristics from what we look for. It has low, volatile, and unpredictable profitability, and so whether it's UBS or Credit Suisse or BNP and SocGen and elsewhere, then it's not really a sector that screens well for us, so we avoid those. In the pharmaceutical sector, we have in the past owned Novartis and Roche, and we may well in the near future. It's a sector we like. It's just that we happen to prefer Sanofi and Novo Nordisk at the moment. Sanofi is at a real inflection point where we expect its earnings to resume growth going forward, and Novo Nordisk is a great play on the epidemic of diabetes globally. So we just happen to prefer those names currently.
So that leaves us with Nestlé.
So Nestlé is in the staples, the food and bev sector. This is a sector where we have individual investments we like, but I think we're quite cautious on the staples sector currently. We don't think that the threat from Amazon and other online retailers to their distribution methods is yet been adequately reflected in their valuations, and they may not be able to repeat the steady growth, kind of mid-single-digit growth with decent margins at 16% going forward. They're going to have to reinvest more in building their brands across several client categories and fragmentation of their client base. And as that rolls out over emerging markets, which has been a great boost to their growth, I think that they might struggle.
Mark Denham, thank you very much for your time.